different asset classes behave differently, or they have different profiles. So when I say behave differently, they have a different risk profile, they have different return profile, they have different volatility profiles. Being able to mix and match asset classes into a single portfolio and thereby bring out a positive impact on client portfolios, or something that is more desirable rather than a single investment outcome, that is what asset allocation is.
Welcome to Money Skills by Scripbox. I'm Sanjiv Singhal, and I'm here today to talk about asset allocation. It's probably the most talked about and the least understood concept in investments. I have a really informed guest here today with me. His name is Rinju Abraham. He's the Chief Business Officer of the PMS business at Scripbox. He's also the man who actually did a data-driven framework creation of asset allocation for us at Scripbox and has been the biggest champion of it within the company. Welcome.
Thank you, Sanjeev. Very, very kind words.
So maybe the first thing, let's get started with what is asset allocation really about? What's the philosophy behind it?
So asset allocation is an approach to investments by recognizing that there are different opportunities for investments. There are different avenues to invest in. But different asset classes behave differently, or they have different profiles. So when I say behave differently, they have a different risk profile, they have different return profile, they have different volatility profiles. Being able to mix and match asset classes into a single portfolio and thereby bring out a positive impact on client portfolios, or something that is more desirable rather than a single investment outcome, that is what asset allocation is. So most advisors who practice asset allocation tend to look at optimizing for multiple variables. Return could be one of them. There could be other variables that an advisor will use asset allocation to optimize for.
So that's a little bit counterintuitive, right? Most people in investing, when you start talking about, you're always optimizing for return, right? So what are these multiple factors that an advisor can be optimizing?
Returns tend to dominate people's minds, but the reality is you've got to think of it like this. In investing, return is one aspect, right? The real benefit of compounding, which is actually comes through time. So the return is actually in the mathematical construct, the return is a multiplier. But time is actually an exponential function, meaning that you could take a hit on the returns, but the longevity of the investment, that's what matters more than the returns, right? So if you take this concept, then the advisor should not be optimizing only on returns. He should be optimizing for the client to make sure that the investment journey is as palatable. Thereby the client remains invested as long as he can. So there are different things to optimize for, and that's what asset allocation comes into.
Okay, so what you're saying is the journey is a challenging one for everyone, and you're just trying to make it as comfortable as possible. And that is an important criteria for an advisor to look at.
The investment journey should be as palatable as possible, because for somebody, a 50%, a 20% fall in the portfolio value could be manageable. But there are people who may not be comfortable with seeing a portfolio fall by 20%. So you actually use asset allocation to optimize for the investor to make sure that he has a good journey. See, that's the role of an advisor. It's not to give the best return. The best return can be achieved in many ways, but the ability to participate in that entire journey is more important. So
time in the market.
Time in the market rather than timing the market. That's a very conventional thing. But this is the longer the better.
Longer the better. Yeah, fair enough, right? So you talked about advisors optimizing for multiple criteria. But as a client, I should understand what are the benefits of a portfolio with asset allocation and without asset allocation?
So let's start without asset allocation. Typically what that tends to be optimized for returns, right? So there is a element of concentration that happens.
Optimized for safety sometimes. My dad would not put his money in anything other than FDs.
Right? That's optimized for safety and stability, predictability of returns, so on and so forth. But an asset allocation portfolio has a few more advantages to it. So let's say, for example, let's take a real life example of the Nifty, which is the Indian equity markets, right? Which represents the Indian equity markets. The Nifty typically has, if you hold Indian equities for around 10 years or so, you should expect a 12 plus or minus 1 or 2% return. That's what you should expect. But these returns don't come in a straight line fashion, right? So what an asset allocation portfolio actually helps you do is include similar assets, include assets with similar risk and reward profiles, but uncorrelated ones. So there was this period between October 2007 and August 2010, almost a 3-year period, where the Nifty actually gave a 0% return. And that is a return on an asset class where you're expecting 12.5%, right? In that same period, a similar risk asset like gold gave a 90% return. That's a 25% CAGR over a 3-year period, where during that very period you are experiencing 0% returns on your core Indian equities. So an asset allocation portfolio would have made sure that you would not have had a dry year, right? So there will be parts of your portfolio that will actually perform and parts that don't perform. So you're actually you're moderating your experience. That's the advantage of having an asset allocation portfolio. But by definition, the asset allocation portfolio also tends to spread it across, so thereby you sort of dampen your returns. So somebody seeking a really high return will probably look for a concentration into a single asset class, and thereby that is what they will achieve. But somebody looking for a journey that is more palatable, like I keep saying, asset allocation makes a lot more sense.
Yes, I think one of the fundamental things is portfolio theory. Right. So asset allocation is a fundamental principle of portfolio theory. If you're not building a portfolio, then you actually don't need asset allocation. Right?
Very true. Very true.
Right.
If you're not building a portfolio, you should. So the idea is for the regular investor. For the regular investor, it is always better to go with a portfolio approach to his investing rather than going with a single investment approach. The single investment approach is a great way to build wealth, but those happen only when you have the time, ability, knowledge, interest, and inclination towards doing that level of research. But most investors don't have that. So it's best to go with a portfolio approach rather than picking one stock or two stocks, right? A portfolio approach gives you that entire. It does dampen the return, but it makes sure that the journey is much, much better.
Yeah. So you talked about these periods of no return, low return, or high return that the markets experience, right? It's actually a pretty obvious question or pretty obvious statement. Equities are volatile, right? But why are they volatile compared to fixed income securities?
See, what are fixed income securities? That's a very broad category. For simplicity's sake, let's take a simple concept. Let's say a corporate bond. Okay. Let's say there is a bank that has issued a certificate of deposit, and it tells you that the bank is borrowing money from you for X number of years, and on that certificate it tells you exactly on what date what amount you will get is in terms of interest, and what dates what amount you will get the principal back. Right. So you have on the paper printed a series of cash flows. Right. So now it's very simple because you know what you're getting. And you know what the current interest rates are. You do a discounted cash flow, and you should know more or less what the value of that particular bond is, right? So that's why bonds aren't as volatile compared to other instruments. Let's take equities on the other hand. What are equities? Equities are essentially ownership interests in businesses, right? So it's a business. By definition, a business is risky. So there is no coupon printed. So you have to, as an analyst or as an investor, make a judgment call saying, what is this business going to do? How much profit is it going to make? How much of that profit are they going to be able to transfer to its owners? And all of these things are made by humans, right? So there is an element of psychology that plays out. And then people with different time horizons come into the picture. So equities by definition is a volatile asset class because the cash flow or the streams of cash flows are not really visible or are subjective to people's interpretation. In bonds, and that's where the difference is. Equities are extremely volatile when compared to a fixed income security or a bond.
So we've talked about volatility of equity. We've talked about asset allocation, trying to dampen that volatility a little bit. But we always say this, right? Equity is a long-term game. So why should a customer actually or an investor actually be worried about volatility in the short run?
Investments are for the long term. I will not look at my portfolio. See, it takes a certain level of superhuman power to be that detached. Let's be realistic. When it is a matter of money, and when the daily values are printed, you will go invariably and you will start looking at your portfolios also, right? Let's be realistic about these things. Although you may have a long time horizon, when you see periods of significant drawdowns, then that's when your rationality will leave you. Okay, I'm reminded of this funny incident where there was an interview with Mike Tyson, right? So Mike Tyson said that a lot of people want to fight Mike Tyson and everyone has a plan. right? They've watched my videos, they've done this, they've done the analysis, they know when to push forward, when to pull back. Everyone has a plan until they get punched in the face by Mike Tyson. That's the reality of it, right? Let's assume that when you build as an advisor has to be rational and realistic about what investor behaviors are going to be like. So can I assume that an investor will not withdraw his money or will not act in a manner that is detrimental with a 10% fall in his profits? Probably. But what if you see a 50% fall in your profit? What if you see a 70% fall in your portfolio value? And this has happened in the past. I'm not talking hypotheticals, right? There was a dot-com bubble, which I was not an analyst then, but there was a 2008 crisis, right? So that I was an analyst and I actually saw firsthand. Indian equity markets saw a 55% decline from the peak. Now, that is not something that most people will stomach. So a 55% decline will see a lot of behavior that is considered human behavior, right? And you're talking about long-term investing, it takes a different sort of metal. So it's best to plan for these by allowing some level of rationality actually creeping into people's decisions. So while investments are meant for the long term, the reality is people will behave in different ways. I've seen that happen, and we've seen that happen throughout the 2008 crisis. We saw it in the COVID crisis where markets fell in a very, very steep fashion. We saw a 22% decline in the markets that time. It's great if you have that level of composure, but plan with a little lower expectation, right?
But, you started by saying that it's not possible, it's very difficult. But let's assume there is somebody who can actually manage to sit very stoically through this 55% decline. This Superman or Buddha, right? He's sitting there. And so for this kind of an investor, is there no added benefit of asset allocation?
No, there actually is, right? The fact that you have an asset class that is currently significantly depressed to a Buddha sort of an investor, or to, let's call him Superman, to Superman, having that opportunity of a depressed price in his asset class of choice is actually a huge opportunity. So let's say that during the COVID crash, or let's say during the 2008 crash, while the market was down to 55%, had he come in with some allocation to gold, and at those opportunities, being able to actually opportunistically move his portfolio from one asset class to a higher conviction idea, because conviction comes when the prices are low, right? That's when real conviction comes in.
Or even not be such a smart investor and just follow asset allocation and rebalance, right?
Rebalancing is one way to do it, because that essentially what it does, it brings back your skewed asset allocation back into the depressed asset class, which typically will be the risk asset that we're talking about, right? So that's when the real advantage comes. A rebalance would actually, by definition, make you overweight the asset class at the right time. Overweight meaning relative to what it was 2 or 3 months ago or prior to the crash. So there are different advantages of having asset allocation. It is not meant only for the investor who's unable to manage these market depressions or market gyrations. There are a lot of advantages.
So given most people are not Superman, right? So how do you decide asset allocation for an individual?
Asset allocation should not always be looked at as being decided for the individual. Asset allocation has a slightly more nuanced approach. So let's say, for example, we recommend at Scripbox that everyone has an emergency fund. We recommend that you have to have at least 6 months of your living expenses in an emergency fund. Now, irrespective of the investor profile, irrespective of whether he is able to take market moves, the emergency fund pool of money should always be in a low risk asset. We recommend that it be in the safest of safe assets. The reason is, typically you will need your emergency fund at the worst of time, right? And that's when typically the market's also going to be really depressed. So you don't want to go and dip into your emergency fund while it is at its weakest. So the objective of the investment in these cases will override the risk profile of the customer. But usually asset allocation is a function of the customer's risk profile, the time to goal, the importance of that goal, how flexible that goal is, the wealth stage of the customer, so on and so forth. There are many, many factors that go into asset allocation in deciding what is the right asset allocation for the customer, and that an advisor is probably the best position to do this for you.
So I think that's a very important point, actually. When we talk about, a lot of people make investment decisions based on friends, family, neighbors, right? And their financial position, their willingness to take risk, their ability to take risk are very different, right? And their goals may be very different from yours.
Let's take a comparison, right? So to health, if you have a cold or if you have a small fever, that's something that you will self-medicate, right? You have a sprain in your ankle, you may give it rest, you may decide not to do anything about it. But for a fractured leg, you don't try and self-medicate. As things sort of become more and more important, or as they become materially significant in your life, they have to be handled by an advisor, right? So when wealth, so there are heuristics. For example, I've heard of this heuristic saying 100 minus the investor's age should be his allocation to debt and equity. That's a very simple heuristic that works for some people, but when you're talking about serious money, talking about your retirement corpus, all of these financial decisions have an impact on your life as a whole, right? So these things is best handled by an advisor. So let the advisor look at all these factors that go into asset allocation. Heuristics work, but they are what they are. Quick decision-making tools, not decided after deliberation. And when it comes to matters of finance, it is best done with a lot of thought and in context to the investor. So long and short, get an advisor whose incentives are aligned to your outcomes and use him to reach your asset allocation portfolio for yourself.
So a number of times you talked about risk assets and non-risk assets, right? So it's a nice framework. I like that framework as well. We've talked about it a lot offline. Do you want to expand on that a little bit?
Yeah. So the way we look at risk assets and non-risk assets, and that's sort of the core of our asset allocation decisions. It's that there are these certain asset classes that have a return profile, a predictability of return profile, and a volatility profile that is very different from your fixed income, or what you would call the non-risk assets, right? There you're looking at assets like the Indian equities, US equities, and gold for that matter. These are what we consider as risk assets, and they have a different profile compared to your non-risk, which is your FD or your savings bank or your debt fund sort of a thing, where the return profile is very, very clear. You know what you're going to get. It's very clear that you're not going to see volatility, and that's the whole construct of risk and non-risk assets. The ability to mix them together in the asset allocation in a portfolio, that's where asset allocation comes to play.
So first decision really is how much risk and how much non-risk, and then within, say, risk, how much of one particular product, and similarly within non-risk, how much of...
In the context of the objective of the investment, the goal of the investor, the personality type of the investor. In that context, the mix between, that's where the first port of call is the mix of risk and non-risk. There is a next stage to that, which is that within the risk assets, what do you choose? Right? That's where it gets a slightly more nuanced.
Yeah, but I think the more important thing there is that you can't choose a non-risky assets when you are choosing a risky asset class. So a lot of people try and say, I want equity that is not risky.
That's a contradiction in terms, right?
Yeah.
So that's the nature of the asset class. It is risky. What you can do is sort of rephrase or sort of go one step lower, one level below what the customers actually or the investors actually asking the advisor. He says he wants the return profile of a risk asset. And there, if you're able to mix and match between two risk assets that have low correlation, then you're sort of giving an investor something more akin to what he's actually asking for. So equities without risk is not a possibility, but equities mixed with gold sort of brings your risk profile slightly lower, because both these asset classes tend to spike in different times, right? So that's what I'm trying to get at.
So I talked about this a little while ago as well, and I want to kind of delve a little bit more into it. Within equities, we talked about there are different types of Indian equities.
Correct.
Right?
That is right.
And I'm specifically leading to this because of all of this fascination with small cap.
Yeah.
Right.
So we're in a time where small caps have done exceedingly well. A lot of people have just entered the markets. They've had a wonderful experience with small caps. A lot of people made a lot of money. And the irony of it is that we are at a time where most advisors will be recommending that people don't invest in small caps. See, there is some merit in this. If an advisor actually uses data, and if an advisor has the client's best interest in his heart, what the advisor has to do is actually optimize, like I said, optimize for longevity. See, let's take the example of 2008, while the large cap index fell from, that's the global financial crisis, when the large cap index fell by 55%, the small cap index was actually, it fell by 70 odd percent, right? 70% drawdown. See, we talk about drawdown. Drawdown is actually a very personal finance concept. It's not academic finance concept, right? Because everyone anchors to the highest point of their portfolio. And a drawdown measures how much you lost from the high point, right? So think of it. If your portfolio was a crore,
How much is going to hurt?
how much is it going to hurt if you see that same portfolio at sub 30 lakhs? It's going to hurt like hell. And that's the worst time. That level of hurt, people will actually move out, and that's probably the worst time to get out. So
Also, the liquidity issues that typically arise at a time like that, right?
Yeah, that is an added complexity with small caps, because these are not essentially easily accessible, and the time that you want to sell it, there may be no buyers. Very similar to real estate, right? If you're a seller, it's a buyer's market, and if you're a buyer, it's a seller's market. Yeah. So what I was trying to get to was, the advisor should look at different segments of the market at different points in time. Different segments of the market actually become more and more interesting, and that's where asset allocation has to take a more nuanced approach. So your heuristics are what they are. It's a tool to help you make quick decisions, but not necessarily sophisticated choices that are required for your long-term goals.
Which is also why, as an advisor, we sometimes talk about strategic asset allocation, which is more static, and tactical asset allocation, which should respond to some of these. And again, it depends on the customer, right?
Yes,
on the investor. What do they like?
You'll be surprised. It's one thing is the investor. The second piece is the investor's responsiveness to when the advisor wants him to change.
Yeah.
So
the time to action.
Yeah, so time to action, and the advisor's understanding of the situation, being able to recommend a certain action, the client actually executing that action based on the recommendation, there is usually quite a distance between the cup and the lip. So
Yeah.
that happens all the time.
So this has been actually pretty useful, and in terms of understanding asset allocation, what the pluses, minuses of this, etc. So on behalf of the audience, right? Ultimately, it has to come down to what is my asset allocation and what are the various asset allocation strategies that one can adopt, and how do you actually implement them.
What you hear in the normal course, or what you read in newspapers, is that there are these jargons that are used: aggressive portfolio, moderate portfolio, conservative portfolio. I'll talk about it more in terms of what Scripbox, because it's closer to my heart. We've actually gone and implemented this to our entire bunch of clients. So at Scripbox, we sort of take these jargons and sort of bring it down into customer speak. So at Scripbox, we say an active growth portfolio. An active growth portfolio is something where the asset classes have been mixed in such a way that an investor should expect to beat inflation by around 4 to 6%. But while getting this as an objective, he should be prepared for a 30 or a 40% drawdown in the portfolio. That's what an active growth portfolio means to us. The nuance here is that the idea is to beat inflation, because that is what actually every investor's objective is, to beat inflation.
Also, just from a benchmark perspective, right? So a pure equity portfolio, for example, might give you slightly better, but it'll have a higher drawdown. And that's really what we're trying to...
higher drawdowns. Like, for example, the active growth portfolio that we have at Scriptbox that we've designed. So we created these portfolio allocations after a lot of backtesting, a lot of regression analysis, so on and so forth. So the active growth portfolio probably had a 35% drawdown when the market was down 55%. So the addition of these asset classes had brought customers a significant benefit in terms of the pain that they went throughout that particular period. The balanced growth portfolio, on the other hand, is a slightly less is a portfolio that's designed for the slightly low risk investor. So there, the idea is to beat inflation by 2 or 3% and expect a drawdown of around 15 or 20% at the worst of what we have seen. When I say expected drawdown, we are all looking at backdated data. Because you have to work with something, you need data to drive your decision making. So we look at data, and then based on the worst of periods, this sort of a portfolio would have seen a 10 to 12% or 10 to 15% drawdown. The safe growth portfolio takes it one notch further, saying that you will be able to meet inflation targets, meet the inflation rate, and have very, very minimal drawdowns. And that's what that is a certain type of investor for whom that works. Then there is the minimum risk piece, where inflation is not considered. The idea is to make sure that under no circumstance are you seeing a drawdown in your
Drawdown.
portfolio. So that is meant for people
My
who
dad's portfolio.
yeah, for a lack of that's one way to look at it. That's how we look at asset allocation at Scriptbox. And the principle has been that we will look at data, we will let data determine the decisions that we make. So it is a continuously monitored process, because all these are all subject to economic cycles, changes. The profile of the asset class could change. Different alternatives could come up for investors, right? So we keep looking at the entire spectrum of available.
For example, US equity actually disappeared.
It disappeared as an alternate, as an investment option for a lot of investors, right? So that's one thing. So we at Scriptbox we try to take a data-driven approach to actually determining what is the asset allocations that should go, and we communicate this to clients, hopefully in a simple manner where customers can actually, we set the expectation saying what to expect, and during that journey what to expect on the downside as well. That's
Okay.
how we look at asset allocation at
So
Scriptbox.
how does it actually get implemented in terms of I'm an investor, I want to adopt an asset allocation, and so maybe I chose an active growth,
Yeah.
right? What happens after that?
Yeah, so that's when an advisor comes to play, right? So the role of an advisor is to do a lot of things in addition to helping you transact. Let's take from an asset allocation perspective, the role of an advisor is to look at what is your risk profile, what is your objective, assign an asset allocation, and then look at the entire spectrum of investment alternatives. See, let's take Indian equities for example. Home country bias, we understand businesses. So if you want to get exposure to Indian equities, it's not only through stocks, right? There are different vehicles that you can get it through. You can go through the mutual fund route, and within the mutual fund, you can talk about actively managed or a passive index fund. You can go through a PMS route, or you can go through an AIF route. So the role of an advisor here is to look at all the available alternatives and then see what works best. There is no one right answer. Like there is no one true religion. There are a lot of useful religions, right? Same thing. That's when the advisor comes in, looks at all the available alternatives and figures out what is the best alternative. And there the decisions could be based on very, very different parameters, right? You just don't look at returns there. You look at ease of transaction, you look at tax treatment, you look at all of those factors, right? Because like for example a PMS, the typical equity PMS, you'll require a 50 lakh corpus to even start the relationship. But not all investors are investing 50 lakhs in one single asset class, right? So mutual fund may make a lot of sense in that context. Or an AIF has a much higher threshold, an entry threshold. So that's the role of an advisor, to look at the available alternatives and figure out in the context of the client, given his profile, given his wealth stage, what is the right product, and that's how you implement it. And look at it from multiple angles and not only from a return perspective. That's how you implement an asset allocation portfolio.
Okay, so another question here, and that's so I've decided on an asset allocation, and suddenly the market's either gone up or gone down, and my asset allocation is all over the place.
Yeah.
Right. What do I do then? Right.
So this is a key concept in asset allocation. This most people talk about as rebalancing. So there are different approaches to rebalancing. There is no one right approach. There are different approaches to rebalancing. Let me talk about a few of these things, right? So one way to look at it is you set a periodicity. Say that once in a year I'm going to relook at my portfolio. A rebalancing is an action, but it's preceded by a review of a portfolio, right? So you review the portfolio, and then if the portfolio has a skew towards undesirable manner, you intervene and you rebalance. So you can rebalance based on a periodicity. You set a periodicity. Once a year on 31st December, I'm going to review my portfolio, and whenever there's a change, I'm going to bring it back to, let's hypothetically say, whatever your decided asset allocation is. There's another way to look at it. The other way to look at it is to look at when it's called the corridor approach. You leave a corridor that allows the asset allocation to get skewed up to a certain level. So you're not actually forcing a date, but you're forcing portfolio allocations to determine when you will go and modify or fix a skewed allocation. So there are different ways to look at it.
So corridor is like if my equity target is 50% and it goes to 60% or it goes to 40%, then I make a
let's say that you say your equity allocation is 50% and you give a 10% corridor. So anytime there's a breach of 10%, so let's say from 50 it goes to 61, 62, 63, that's when you sort of intervene and then bring it back to your desired allocation. So these are different. These are different approaches. Like I said, there is no one great religion. Each advisor has his. Go to an advisor. He will have his philosophy. He would have done the homework. He would have done the math behind it, and then he will recommend what he thinks is right for you. So use an advisor. Review the portfolio periodically. That is the precursor to, you don't have to act. A review does not necessarily mean an action at the end of the process. Review it and act when it is required.
That action tends to be actually very difficult because, to give you an example, you just said your portfolio allocation for equity is 50%, it's gone to 65, and that usually will happen when the markets run up.
Correct.
Right? These are good times, everybody's partying, and the investor now is being asked to sell that equity and leave the party early, right? So
intuitively it seems like that's human behavior, right? You really don't want to stop when you're on a high, but that's where the real value of a advisor is, or that's what is the right thing to do. If you look at teenagers and their parties, right, there is a point at which you have to pull out the punch bowl. Somebody has to do it, and it's usually the sane person, or the person who's really not high, who actually knows what is the point at which you have to intervene. So use an advisor, take his advice, but make sure that you're going with somebody who, like I said, has his interests, has his remuneration aligned to your interest, takes a data-driven, evidence-based approach, does the adequate homework. Go with somebody who's actually qualified. So the beautiful thing about Indian equity markets is you have a very strong regulator, and to be an advisor, you have to have certain qualifications. So that's a good thing, right? So use an advisor. I know I'm tooting my own horn because we are advisors at the end of the day, but nevertheless, there is merit in using an advisor and letting him at least indicate to you when it is time to intervene in your asset allocation.
Great. Thank you so much, Rinju. This has been very, very enlightening. Refreshed a lot of my concepts of asset allocation.
Thank you very much for having me, and I hope it's useful to our customers and useful to anybody.
So that brings us to the end of this episode. Thank you, Rinju Abraham, for joining us.
It's been a pleasure.
I hope you enjoyed this episode and learned a few things like I did. If you have any questions about the topic of asset allocation, please put your questions in the comment section below. I hope you really enjoyed this show. And if you did, please like, share, and subscribe. Thank you very much, and we will see you again for the next episode.